Legendary investor Dalio says the bond market is the backbone of the entire financial system. The bond market determines the risk-free interest rate that influences almost every asset. When supply and demand become unbalanced, long-term interest rates begin to rise. Currencies weaken while investors move money into gold. This creates a difficult situation for central banks. The Federal Reserve controls short-term interest rates. Long-term Treasury yields are controlled mainly by investors through supply and demand. America keeps issuing trillions of dollars in new debt every year. For decades, Japan absorbed much of this debt. If Japan buys fewer treasuries, yields must rise to attract new investors. The Federal Reserve can cut short-term rates while long-term rates remain high. This creates a steepening yield curve. Higher long-term yields reduce stock valuations. Investors pay lower prices even if company earnings remain strong. Mortgage rates are closely tied to the 10-year Treasury yield. If Treasury yields stay high, mortgage rates stay high too. High mortgage rates reduce housing affordability. Businesses also suffer because borrowing money becomes more expensive. Cheap borrowing encouraged companies to issue huge amounts of debt during 2020 and 2021. Today, that era of cheap money is ending. The unwinding of Japan's carry trade removes one of the world's largest sources of liquidity. Financial conditions become tighter across global markets. Most financial media ignores this slow structural shift. People pay attention to AI, inflation, and daily stock headlines instead. Many people believe one Federal Reserve rate cut fixes everything. But weaker demand for treasuries can keep borrowing costs high. Less liquidity means money becomes more expensive everywhere. This affects stocks, mortgages, and business investment at the same time. The biggest market risks are often the ones hiding in plain sight. Understanding these hidden forces helps investors see the bigger picture.